Hey, welcome to The Explainer. Today we're going to tackle a really important accounting rule, IFRS 5. And I know, accounting rule doesn't exactly scream excitement. But trust me, this one is basically a financial flare gun. It signals a company's biggest moves, like selling off a huge piece of itself, way before the deal is actually done. So, let's get into it.
Okay, so just imagine this for a second. You've got this massive company, and they decide they're going to sell off a huge part of their business. Maybe it's a factory, maybe it's an entire division, whatever. So how do they actually tell everyone? How do investors find out what's going on? Well, it's not quite as simple as just sticking a for sale sign out front, right? And that's exactly the problem IFRS 5 is here to solve.
All right, so for our story today, let's meet the main characters. First, we've got Megacorp, our fictional giant. And then we have its Phoenix factory, a really big, important asset. So one day, the big wigs at Megacorp make a huge decision. They're selling the factory. They want to focus on other things. And bam, that one decision is the trigger. It's what kicks off all the very specific rules of IFRS 5. And this is really the key thing to get. The second Megacorp commits to selling the Phoenix factory, it's not just another piece of property on their books anymore. No, its entire accounting identity changes. Think about it. It's no longer a tool they're using to make products for the future. It's now basically an item for sale, and its value is all about how much they can get for it. This whole shift is why you need a special set of rules to keep everything transparent for everybody involved.
But here's the thing. A company can't just say it's for sale. It can't just be a vague idea they're kicking around. IFRS 5 sets up this really strict test, like a checklist of hurdles the asset has to clear before it can officially get that held for sale classification.
And this checklist, this is where the rubber meets the road. It's pulled right from the standard, and it is demanding. First, management has to be totally committed to a plan to sell. No maybes. They have to be actively out there trying to find a buyer. The factory needs to be ready for an immediate sale, as is, and it has to be marketed at a realistic price. Oh, and the whole deal is expected to be done within a year. Plus, it's got to be unlikely they're going to back out. You can see it's a really high bar, and that's on purpose. It makes sure only the truly serious sale plans get this special accounting treatment.
So if and only if the asset clears all those hurdles, it earns this official title, held for sale. And this definition is really the heart of the whole thing. It means the company is fundamentally shifting its story. They're moving from, we're using this asset to make money, to, we're going to cash out on this asset. Okay, so the Phoenix factory has passed the test. It's now officially held for sale. And this is where the accounting gets really interesting, because now how it's treated on the financial statements is going to change dramatically.
And this slide just lays it out perfectly. The two biggest changes. Before, the factory was just on the books at its carrying amount, its book value, and you depreciate it a little bit every year. Simple. But now, that all goes out the window. Now, it's measured at whichever is lower, its book value or its fair market value minus any cost to sell it. This is super important because it stops companies from carrying the asset at an inflated price on their books.
And the other huge change? Depreciation just stops, dead in its tracks. And the logic here is actually pretty simple. You depreciate something because you're using it up over time to generate revenue, right? But the Phoenix factory isn't a productive tool anymore. You can think of it more like inventory on a shelf, just waiting to be sold.
And just so we're all on the same page, when I say fair value, I'm talking about the official definition. Basically, just think of it as the real-world market price. It's not some pie-in-the-sky number. It's what the factory would probably sell for in a normal, orderly transaction between a buyer and seller who both know what they're doing.
Now, all these changes aren't just for some internal spreadsheet. Nope. The whole point is to put a massive spotlight on this big strategic move for absolutely everyone to see, investors, banks, you name it. So let's take a look at how this actually shows up on the financial statements. So here's a super simplified look at Megacorp's balance sheet before they decided to sell. See that big line, property, plant, and equipment for $500 million? Our Phoenix factory, let's say it's worth $80 million, is just buried in there. You'd have no idea it even existed as a separate thing. But now, check this out. This is the after picture. The Phoenix factory has pulled out from the group and gets its own special line item, assets classified as held for sale. It is right there in black and white, impossible to miss. This is what we mean by transparency. Any analyst looking at this knows instantly that a major sale is in the works.
And you know what? It can go even further. If the factory is a big enough deal, like a whole separate line of business, it also gets labeled as a discontinued operation. And what that means is its profits and losses are also pulled out and reported separately on the income statement. This gives investors a crystal clear view of how the rest of the company is doing without that piece.
Okay, but life is complicated, right? What if things change? What if a new CEO comes in? Or the market completely shifts, and Megacorp decides, you know what, we're not selling the factory after all. Well, IFRS 5 has a plan for that too.
If they cancel the sale, that held for sale label comes right off. But it's not as simple as just putting it back where it was. The rules say the asset has to be remeasured at the lower of two numbers, either what its book value would have been if they'd never planned to sell it, and that includes catching up on all the depreciation they missed, or its actual recoverable amount today. This is a clever rule to stop companies from playing games to artificially boost an asset's value.
All right, so we've gone through a lot of details and rules. Let's zoom out for a second and ask the big question. Why does any of this really matter? Why is IFRS 5 so important in the grand scheme of things?
The standard itself actually says it best in its opening paragraph. The entire point is to standardize how companies report these big sales and discontinued operations. It's about creating a common language, a clear and consistent set of rules, so that an investor in Tokyo can look at the financials of a company in Berlin and understand exactly what's happening.
When you get right down to it, IFRS 5 is really a storytelling tool. It forces companies to be honest and upfront about their big strategic shifts. When a company decides to get rid of a major part of itself, this standard makes sure that story is told clearly and that the financial impact is totally understood. It's not just about where a company has been, it's about telling the true story of where it's going.
So, the next time you're digging through a company's financial reports and you see that little line item, assets classified as held for sale, you'll know it's not just a number, it's a signal that a big change is happening. The real question is, what story will you be looking for behind those numbers?